Hi, my friend. The guy I was working with the other day from Texas shared me his strategy, which I'm actually very intrigued by. Which was he was going to annuitize everything at I think 59 years old when he separated from service, even though the annuity money would be vastly more than the expenses that he needs. So he says, I like the idea of having more. I like the idea of having control, i.e., I have the money where I can decide what to do with it, not be at risk of the market. So it's a way of dealing with the sequence of return risk. I thought, that's pretty interesting. So I want to try a quick experiment, and I'm thinking this through, and I'm sure there's a million ways to Sunday to see how this works. But essentially, what we're going to do is we're going to go to Right Capital, and it will pretend it's me and Charlotte, my wife, and we're going to say we got $500,000 in an IRA. All right, it's my IRA. We got $500,000 in the S&P 500. The S&P 500 we expect to give us 7.4% rate of return. All right, and then let's see. Let's go to profile. We need goals. 4,000 a month in retirement expenses. That's all inclusive. So basically, 50,000 a year is what we need in retirement expenses when you factor in taxes, and that includes healthcare, that includes food on the table, housing, the whole thing. Just saying, we need $50,000 a year. We're going to let's go to Social Security. My Social Security, I'll plan on taking when I'm 70, and we'll say my PIA is 2,900. Charlotte's Social Security, she'll plan on taking when she's 67, and her PIA is 1,000. All right, so I hope that makes sense. So the questions that comes in, let's go to retirement. Pablo's got his head up, so he's thinking he's waiting for my oldest to come home, in which case I'm sure he'll bark. We got 97% probability of success. We're leaving $2 million of liquid net worth, which is pretty good. So let's take a look at what the confidence looks like. And that dark blue graph there, you can see at 69 and 70, because we're not taking Social Security, basically 95% of the time we have over $31,000. Our median liquid net worth is $328,000, which means 50% of the time we have more, 50% of the time we have less. But then when Social Security starts kicking in, that blue vein starts rising quite nicely because Social Security is more than enough to pay our bills. In fact, we got 1 million here at when I'm 83 years old, so that's pretty good. So we're not run out of money. All right, so we got 97% chance of success. We're not run out of money. Let's take a look at the cash flows. You can see we have no income at all for 1, 2, 3, 4, 5, 6 years. No income. And then even 7 years, we just got Charlotte's little bit of Social Security. That's it. But we have expenses, 48,000, 49, 50, 52, 54, 55, 57. So it's basically 1, 2, 3, 300, let's say $375,000 is what our expenses are when you factor in taxes as well. So we need 48,000, but we have tax payment of 22,777 because it's all coming from an IRA. So our total outflows is 50,777. All right, hold on, I'm gonna pause it. We need 50,777 to live on because we got to pay that $2,700 in taxes. So just to show you how that works, I get this a lot with a Roth IRA. Where are the taxes coming from? Hey, buddy. And I'll show you right here. So we take withdrawals from accounts. Our total withdrawal in order to live on $48,000 from the IRA is $50,777 because we got to pay the taxes. And the same thing happens with Roth, my friends. Even if you don't have money to pay the taxes for your Roth IRA, it's coming from the IRA in which to pay the taxes. So it's a $48,000 net distribution, but it's $50,777 that you're taking out. Hope that makes sense. All right, so let's go back to summary. But again, we have no income flows. Let's just look at the tax form here real quick. 2020. We see a taxable amount of IRA distribution, $50,777. We got standard deduction of $24,000. It puts us in a $26,000 taxable income, which effectively is a 10% tax bracket. So, okay, so you see that. Actually, it's going to be effective a lot less than that. Effective tax bracket will be a lot less. In fact, we can see what the effective tax rate will be. If we go here, yeah, so the effective tax rate is about 5.5. Okay, so that's not so bad. All right. So let's as you can see, here's the widow's tax trap. It goes from 9.6 to 16%. We're not going to get in that so much right now, but let's just let's take a look at cash flows again. Anyway, so again, don't forget, $50,000 off a $500,000 portfolio is a 10% distribution. and yet we're still coming out fine because Social Security kicks in. When I die, Charlotte's income drops from 126 to 94, but her taxes go from 15,800 to 26,000. But she still has a lot of net assets. So let's go to accounts, and you got the IRA money, then we got the taxable money, because every time we have money from the IRA for RMDs, it's got to go someplace. So let's go withdrawals from accounts, and you can see, bear with me just a sec, let's go to RMDs. So you got 31,000 for RMDs going to your taxable account, and your taxable account is building up each and every year. I don't think net cash. Yeah, so there's your net cash flows. So we're taking RMDs there. We're adding to the taxable account. The taxable account also has its own earnings as well. All right, so let's. That looks pretty good. I wonder if let's just do Social Security. I was just curious. We'll do Social Security at. We'll do full retirement age. What does that look like? Yeah, it actually makes it a little bit better from a percentage, even though it makes it less, not much less on a terms of total income. In this case, I probably would take Social Security. It's 67 actually, but all right, so that's fine. So what I want to do is let's now go ahead and annuitize everything, and we got $500,000. I guess, yeah. So let's annuitize. We got $500,000 in an IRA. And we're 60. We're going to say we got 6% annuity. That gives $30,000 a year. All right, so let's do this. Let's do Social Security. We're going to annuitize. We got 1.9 million. Let's take Social Security early. And I don't know what that's going to be. 62. All right. And we're going to have Charlotte taking that 62 as well. So we're going to have her taking a 62, I'm taking a 62, and then we're going to add an annuity of $30,000 a year. No, we're going to have to leave $50,000 in a side account to pay the tax. No, we won't. We can pay the tax from Social Security. Let's see. Let's just do it. Okay, we're going to have it for calendar year, life. We're going to do 100% survivor. Okay, gotcha. And let's see what, and then we're going to not increase it. We're going to say no increase. Okay. Now we got to take that off this. We're going to not include it in the plan. Okay. Now let's see. So you see what we're doing? We're saying, okay, we're going to take out that $500,000 IRA that I have, annuitize it. It's going to generate $30,000 a year for the rest of my life, in Charlotte's life, whoever lives long. And then we're going to take Social Security right out the gate. So let's see what this looks like now. Still got 100. Oh, yeah, look at that. Still got 100% success rate, but we only have $300,000 left. Cash flows. So our income flows 56,000. That's going to be from the annuity and Social Security. So my Social Security is 26,000. Hers will be next year 12,000. So that's 38,000 there. All right. And our annuity income is right there, $30,000 bucks. So our total income is $69,000, $70,000 bucks once Charlotte's getting Social Security as well. All right. Now let's go to accounts. So all that money's got to go someplace. It won't be withdrawal from account. It'll be net cash flow. Yeah, so we're adding. Let's actually look at taxes. Yeah, look at that. So we're staying in a low tax bracket. 3.6. That jumps up quite a bit to 7.8. That's interesting to me. Confidence. Oh yeah, look at that. That's interesting to me. So let's see what it looks like when we die. Hi. So we're gonna net worth is what I want to say. Excuse me. Yeah. So the non-qualified assets are growing because that's the amount of money we're adding to it, because we have more income coming in than we're spending. Yeah, I think it stopped growing at some point. Let's see. Yeah, it does. All right, so it stops growing because at that point the annuity isn't paying, adjusting for inflation. So at that point we're dipping into principal, because we don't have enough income from, let's see, withdrawals from accounts. Later on down the road, yeah, we're gonna have to start taking money from the non-qualified account because we don't have enough income. So let's go back to cash flows. Summary. So yeah, right here. So when we got net flows, let's just do this. All yours. So we got net flow of 7,000, 18,000, 18,000. All that should be going into the 7,000, 18, 18, 18. That all that should be going, and then look, it starts dropping as inflation kicks in. So our expenses are going up from 48 to 50. Well, then you got factoring taxes to 60. But because the annuity is only $30,000, it's not adjusted for inflation. Yeah. So our expenses are going up, but our income is staying relatively low. It's only going up by a little bit with the cost of living for inflation. So 88,000, 90,000, 91,000, but our expenses are going up, and at some point it's going to catch it right here. Our income is 107.5 and our expenses are 108.5. So that's still not too bad. And if we go down to our net worth, oops. Yeah, 334 at our death, which isn't bad. All tax free, by the way. Invested assets, yeah. But it shows the portfolio return. What's that portfolio return? What's that giving us? I don't know. It doesn't look like much. So just put in the cash. Let's see. We got 225. 454 is our present value. We're adding 11,241 to it. And we're 238,950 is future value. One and I can't be. I'm doing something wrong here. And look at that. We're adding 10. See, that's something wrong here. So let's do this. Let me pause for a second. See what happened here, because I had no investments at all. It just put me all in fixed income, all in cash. That's not going to get the job done. So if you look at cash, you go to retirement. I said, why is the return so low? Only $305,000. And the reason for that is, watch. We go to accounts. Additions was it net cash flows? What was that here? What was that? Hold on just a second. Go to addition to accounts. Any balance by accounts? Nope. Wasn't that withdrawals? Wasn't withdrawals. Oh, wait, is it net worth? Huh. Invested assets. There we go. Okay. So here we go. And so I said, wait a second. We got 63,000 in there to start. We added 17,000, and we only made $631 on a $63,000 portfolio. That meant it was solely in cash, and I didn't realize that until I just had messed around with it a little bit. So if you look, we have a 0 stocks, 100% bonds. All right. So, but what I did then is I said, okay, forget that. Let's pretend we have a portfolio, and I went to investments. And I added 1 share of VFINX, the S&P 500. That way we can now hit included in plan. And what we'll do is we go to investment, and what you'll see now is 100% stocks. Okay, so that's more of an even approach there. So now let's take a look. Retirement. And look at that. Now it's $969. So we're leaving almost $1 million. That's interesting. So let's take a look here. And yeah, there we go. So remember, this is taking Social Security at 62. That's interesting. At 63. What if we left? How else could we do this? And annuitizing everything. There'd be no other way to do it because you have to have some money to pay the bills until, if we just did 250. So let's do this. Let me try something else. Because we have to have some kind of money to pay the bills while we're waiting for Social Security to kick in. Let's try one other thing here. Time check. 413. Okay. So what if we go to investments and we're going to go to this guy. We're going to put this as including plan, but instead of 1800, we're going to do, so 1816 divided by 2, 908. So now what we're going to do is we're going to annuitize. We're going to leave this in here to allow us to defer Social Security until I'm 67. And that will leave us $250,000 in cash. All right, hope that makes sense. To live off. All right. And now we're going to take Social Security at 67. I think I can get away with it. Maybe we'll see. We'll take hers early. Yeah, we should be able to get away with that. Let's take a look. Ooh. Oh, wait. You know what I got to do? I forgot to change the annuity. Hold on just a second. Make that 15,000. Interesting. That totally eliminates the sequence of return risk. We use a little bit less at the end of the day, but it takes that risk off the table, and everything you're leaving is still being left tax-free. Your tax should be pretty low here too, I think. Yeah, look at that. 6. Huh. That's nuts. That is nuts. Let's go to net worth. So what's happened here is we're taking money out of our cash account because we need 50,000 a year to live on. Let's just count. Because Charlotte's got her Social Security, so we need 33,000 a year to live on. Once I hit Social Security, oh look, we can even wait. Oh man, this might be the way to do it. This might be the way to do it. We can even wait to take Social Security until I'm 70. Let's go back to profile. Income. I think this might be the way to do it. You're totally leaving sequence of return risk off the table. Yeah, that works. That works. Oh, dude. That's freaking crazy. That's freaking crazy. Income flows 15,000 from the annuity. Charlotte, now we're going to take money out of the cash account to pay the rest. We need 48,000 expenses. We don't have any taxes at all. Well, I guess if it was an IRA, it'd still be taxed. It's okay, buddy. It was like, I guess going to the other house. Then Charlotte gets Social Security. We need 24,000. The rest got to come from. It's going to come from the savings account we have, which is this taxable account right here. So we're taking 33,000 first year, 25 the next, 26, and then come 70. We're not taking anything. How much is left in that taxable account at that point? It's 97,000 bucks. Oh no, it's me, buddy. Sorry. And then look at this, and then it's growing. No, it's me. It's just me, buddy. That's okay. It's okay. That's all right, Growly. And then when we're at a beginning balance, 637,000, we're taking $18,000 out, but we're adding net cash. Man, I tell you, this is the way to do it. All right, I got to think on this a little bit. So the situation, let me just revisit this with you. The situation is the risk that everyone's facing with when they first retire is the sequence of return risk. Well, if you need a certain amount of money to live on, you take that out of your IRA, not necessarily take a distribution, but you put into a cash account at some point. Now, in this case, I did a distribution, and I should have left in the IRA, but it's irrelevant. It's not that big of a deal because the taxes are so low, if anything. So you're taking, in this case, we took half the money we think we need to live on until I hit Social Security. All right, so we're putting, in this case, $250,000 in a cash account, a stable value fund, Ginnie Mae, however you want to do it. And then we're annuitizing the remaining amount. So that's $250,000 being annuitized, which gives us an income of $15,000. We need $48,000 a year to live on. So we need, in the first year, we need $33,000 from that cash account, that cash bucket. The next year, when Charlotte's Social Security kicks in, I have the $15,000 annuity plus her Social Security is $12,000. That's $27,000. We only need at that point $23,000 to live on, and that's going to come from the cash bucket, which had $250,000 in there initially, but now it's got a little bit less. But that bucket stays intact until you're 70 when you take Social Security, and then you're just adding to it because you get your annuity of $15,000, your Social Security, and you don't spend enough because all that is much more than your expenditures, which means you're reinvesting in a taxable account, which is growing. So you got sequence of return risk, and you got reverse dollar, or you got dollar cost averaging. And on top of that, we're still pretty good relative to the overall net worth. We have a 100% success rate. Yeah, we have a $300,000 less as overall net worth, but that's all right. I got to chomp on this a little bit. This is fantastic. So, my man Harry, this is a good plan of action. Never thought about it, and I'll dive into this deeper. I'll see you.